Have you ever felt the market is hunting you? Like it knows where your stop loss is hiding, waiting to erase you in one brutal move? It's not an accident. It's not bad luck. It's liquidity. And if you don't understand it, you are the liquidity. If you've ever wondered why your stop losses get hit, why price reverses the second you enter, or why your analysis never plays out the way you expected, this video will open your eyes. Do you really think the market is random? Or is someone behind it, pulling the strings? The trap beneath the surface. Picture this. You open your charts, confident, analyzing the candles. Price is consolidating, bouncing between support and resistance. You think you see a perfect setup. Your hand hovers over the mouse, ready to pull the trigger. But what you don't see is the trap forming right beneath your feet. Liquidity. The silent force that dictates every move of the market. Every equal high, every equal low, every trend line, every order block, every support and resistance level, these are not safe zones. They are traps. When you place your stop loss right under that equal low, you are not protecting yourself. You are volunteering. You are volunteering to become liquidity. The market is hunting you. It's not random. It's engineered. If you don't understand liquidity, you are the hunted. If you master liquidity, you become the hunter. Equal highs and equal lows, the illusion of safety. Equal highs. Equal lows. They look clean. They look safe. They look like solid market structure. But in reality, they are magnets. Liquidity pools. Traders see equal highs and think, that's strong resistance. Price will reject. They pile in their shorts. They set their stops just above. What happens next? Price spikes. Sweeps the equal highs. Grabs every single stop. Then reverses violently. The same happens at equal lows. Retail longs stack up. Stops are tucked neatly beneath. The market dives, wipes them out, and then explodes upward. This is the psychology. The illusion. Your brain craves patterns. It wants order. When you see equal highs, your mind whispers, this is strong. But the truth? Equal highs scream weakness. They scream opportunity for the institution to manipulate. Every time you think you're safe, you are sitting on the bullseye of liquidity. Trendlines, the false comfort. Trendlines. Every beginner loves them. Drawn neatly across higher lows, across lower highs. You think the trend line will hold. You believe institutions respect it. But here's the dark truth, trend lines don't hold because of strength. They hold because liquidity builds beneath them. Every touch invites more traders in. More stops accumulate just beneath. And when the time is right, price slices through like a hot knife through butter. Stops are triggered. Accounts bleed. The liquidity is harvested. The more beautiful the trend line looks, the more dangerous it becomes. Because beauty attracts the crowd. And the crowd is fuel for the hunt. Your psychology betrays you here. You are drawn to clean, simple visuals. But the market punishes simplicity. It thrives on your predictability. Order blocks, the wolf's Denver. You've probably heard the hype about order blocks. Banks respect order blocks. Institutional footprints live here. But let's break the illusion. Order blocks are not magical safe havens. They are areas where liquidity is concentrated. Every breakout trader piles in. Every retail trader places stops around them. The institutions knows this. They engineer price into these zones, not to respect them, but to exploit them. The order block is not protection. It's the wolf's den. And here's the psychological dagger: you think you found the secret. You believe order blocks will save you. That belief is exactly what makes you a target. Your confidence is their opportunity. The deeper your conviction in the wrong concept, the easier you are to manipulate. Support and resistance, the oldest illusion. Support and resistance. The oldest trick in the book. Every beginner learns it. Every course teaches it. Buy at support, sell at resistance. It feels logical. It feels safe. But what really happens? Every bounce from support builds liquidity beneath it. Every rejection at resistance builds liquidity above it. Over time, the pool grows. And then, when the pool is large enough, price rips through. Sweeps the stops. Turns your supposed safe zone into a slaughterhouse. The psychological game here is brutal. Support and resistance train your mind to trust repetition. You think, it bounced here before, so it will again. But the market is not about repetition. It's about deception. Support and resistance aren't walls. They're bait. The thicker the bait, the deadlier the trap. The psychology of the stop loss. Let's pause here and go deeper. Why does your stop loss always get tagged before the move? It's not random. It's not bad luck. It's by design. Stop losses are not protection. They are liquidity. Every single stop is an order waiting to be triggered. And the market feeds on orders. Think about the psychology: when you enter a trade, you're optimistic. You place your stop at the logical spot, beneath support, above resistance, under equal lows, above equal highs. You feel safe. You feel disciplined. But here's the trap: your discipline is predictable. If you can see the level, everyone else can too. And if everyone else can see it, their stops cluster there. The very thing you believe protects you is the very thing that exposes you. The market doesn't need your opinion. It needs your orders. And your stop is the perfect order. The anatomy of a sweep. Let's dissect the sweep. What actually happens when liquidity is taken? First, the build. Price respects a level over and over. Traders gain confidence. More entries pile in. More stops stack up. Second, the lure. Retail thinks, this level is unbreakable. They enter heavier. The pool grows. Third, the sweep. A sharp move pierces the level. Stops trigger. Breakout orders trigger. Volume spikes. Fourth, the aftermath. Now comes the decision. Rejection or acceptance. If price snaps back inside, the sweep was a trap. If price holds beyond, the sweep was fuel for continuation. The psychology is brutal. Retail feels betrayed. They scream at the screen, "Why always my stop?" Because your stop wasn't hidden. It was advertised. If you can spot the pattern, so can the market. If you think you're clever, you've already lost. Reversal plays, turning the trap into profit. Now, let's turn pain into power. You see equal highs. You know stops sit above. Price spikes. It wicks just beyond. Retail stops are gone. Breakout longs are in. Then what? Price rejects back down. Market structure shifts. The move reverses. Here's your edge: wait for the sweep. Wait for the rejection. Then strike. Entry comes after confirmation. After the lower time frame break. After the market tells you, trap complete. Reversal engaged. Psychology shift: instead of being the victim, you become the predator. While retail screams in pain, you ride the reversal straight to the opposite liquidity pool. Don't predict. React. The hunter never chases the prey before the trap snaps shut. Continuation plays, riding with acceptance. Sometimes, the sweep isn't a trap. Sometimes, it's fuel for the real move. Equal lows break. Stops trigger. Price holds beneath. This is acceptance. The market has chosen a new territory. Your job? Trade with it. Don't fight acceptance. Don't bet on a reversal that never comes. Entry, on the retest. When price confirms it wants to stay below. Stop, above the reclaimed line. Target, the next liquidity pool. The psychology here is discipline. Your brain wants revenge. It wants to buy the dip after your stop was taken. But you must silence that urge. You must accept acceptance. When the market tells you where it's going, don't argue. Follow the fuel. The crowd's mind versus the smart money's mind. This is where it all connects. Retail and smart money do not see the same chart. Retail sees patterns. Equal highs. Double bottoms. Strong resistance. Smart money sees liquidity pools. Fuel. Order flow. Retail thinks, support is strong. Smart money thinks, support is weak, look at the stops underneath. Retail thinks, trendline respected again. Smart money thinks, perfect. More stops for later. And the psychology? The crowd is emotional. They crave certainty. They need patterns to feel safe. Smart money is ruthless. They exploit emotion. They exploit certainty. The moment you feel safe is the moment you are most exposed. The moment you feel fear is the moment opportunity is near. This is the split brain of trading. And until you rewire your psychology, you will always be prey. Support and resistance, the illusion of safety. Everyone learns it, by support. Sell resistance. It sounds logical. It looks easy. And it's why so many accounts bleed. Why? Because support and resistance are magnets for liquidity. Think. If you buy support, where's your stop? Just below it. If you sell resistance, where's your stop? Just above it. Now zoom out. Thousands of traders worldwide place the exact same stops. What do you think that creates? A massive pool of orders. What you see as safety, the market sees as food. The first touch of support or resistance rarely holds. It usually breaks just enough to collect stops, sweep the pool, and only then decide, rejection or continuation. You thought you were smart buying support. But the market knew your play before you did. Decoding the range market. Most traders lose not because they can't predict the trend, but because they don't even realize they're trading a range. You can't fight a ghost if you can't see it. Let's make the invisible visible. Here's the cold truth, 80% of the market's life is not trending. It's ranging. Sideways chop. Price stuck between invisible walls. And if you mistake that chop for a trend, you'll bleed. Slowly. Death by 1,000 stop-loss cuts. So how do you see a range before it kills you? 1. Equal rejection. Watch the highs. Watch the lows. If price taps a high and gets rejected, then comes back later, taps again, and gets rejected again, you're staring at the roof of a range. Same for the floor. If price kisses the bottom twice and can't break, that's your range boundary. 2. Overlapping candles. In a trend, candles push. They expand. Higher highs in an uptrend. Lower lows in a downtrend. In a range, candles overlap. They share the same ground. Like footprints pacing back and forth in the same hallway. 3. Wicks everywhere. Sideways markets love to stab. Long wicks above. Long wicks below. Like the market is testing both doors, but refusing to walk through either. That's the fingerprint of compression. 4. Time factor. If price spends hours, sometimes even days, bouncing between the same ceiling and floor, you are not trending. You are stuck in a liquidity chamber. 5. The two-touch rule. This is the simplest test. 2 solid rejections from the top. 2 solid rejections from the bottom. That's not a coincidence. That's structure. That's a range. Retail traders hate patience. They see every bounce as a new trend forming. Double top. Time to short. Double bottom. Time to long. But they miss the context. Those aren't new trends. Those are walls. And the more times price bounces, the stronger the trap. Trends make you money. Ranges take your money. The difference is not your strategy. It's your vision. Think of ranges as cages. The market is the animal pacing inside. You can't predict when it will break free. But you can recognize when it's still trapped. And until the door opens, your only job is to wait. The reclaim trap, how the market tricks your mind. Here's the cruel part. Price breaks below support. Your stop triggers. You're out. Then what? It instantly bounces back above, reclaiming the level. Now you're angry. You feel betrayed. That's not an accident. That's a trap. The sweep wasn't random, it was engineered to flush you before the true move began. This is where the reversal play lives. Wait for the sweep. Wait for the reclaim. Confirm with structure shift. Then enter. Your natural instinct after being stopped is revenge. You want to jump back in, emotionally. But the real edge is patience. Waiting for proof. Your impatience is their profit. Your patience is your edge. The range trap and trend ignition. This is the silent phase most traders ignore. The phase where the market is loading the gun before it fires the bullet. Miss this, and you'll always be late. Master this, and you'll catch the trend before the crowd even realizes it exists. Picture this, you're staring at the chart. Price moves sideways. Candles overlap. Wicks stab both directions. It looks boring. It looks dead. And most traders tune out. But here's the truth, a range is not silence. A range is compression. It's the coiling of a spring. Every equal high inside the range is liquidity. Every equal low inside the range is liquidity. And the entire sideways chop is just one giant pool being built. The trap? Retail traders try to predict the breakout. They long at the top of the range, short at the bottom, stop stacked neatly on both sides. And while they bleed, smart money is watching. Psychology dagger, your brain hates boredom. It craves action. In ranges, you force trades. You manufacture setups. And that impatience is exactly what fuels the pool. So how do you know when the range ends, and the trend begins? 1. The sweep comes first. Every strong trend starts with a sweep. Price hunts liquidity on one side of the range. Maybe it spikes above the highs. Maybe it dips below the lows. But one side always dies first. 2. Watch the reaction. If price sweeps one edge and snaps back inside the range, that's your fake-out trap. Liquidity collected. Trend often forms opposite the sweep. If price sweeps one edge and holds beyond, that's acceptance. The breakout is real. The new trend is born. 3. Structure shift. After the sweep, zoom into lower time frames. Look for a break of structure. A higher high forming after a downside sweep. That's the ignition of an uptrend. A lower low after an upside sweep. That's the ignition of a downtrend. 4. Timing. Ranges usually resolve when volume arrives, London Open, New York Open, or during news. Sideways price plus sudden spike in volume. That's your warning shot. The trend doesn't start when you see the breakout. It starts when liquidity on the wrong side is already dead. The crowd sees ranges as wasted time. The hunter sees ranges as the loading chamber. The bullet is coming. The only question is, which side will bleed first? If you master ranges, you won't just spot the beginning of trends. You'll ride them from the very first step while the crowd is still confused, still trapped, still prey. Acceptance, when the market really means it. Not every sweep is a fake out. Sometimes the break is real. Sometimes, price holds beyond the level. That's acceptance. Support breaks, price retests from below, and holds. Resistance breaks, price retests from above, and holds. This is not a trap anymore. This is continuation. Fight it, and you'll be crushed. Follow it, and you'll ride the wave. Traders love fighting acceptance. Why? Ego. You think you know better. You think the level must hold. But the market doesn't care what you think. The market doesn't need your opinion. It needs your obedience. Trendlines, the most trusted, most exploited tool. Every retail trader loves trendlines. 3 touches, 4 touches, it looks strong. But here's the reality, trendlines are liquidity lines. Stops pile just outside the line. Breakout traders place entries right through it. And what happens? The first clean break almost always sweeps liquidity. Either, snap back reclaim, a trap. Or clean acceptance, continuation. The more times price respects the trend line, the more confident retail becomes. The more confident retail becomes, the bigger the stop pool grows. And the bigger the pool, the bigger the hunt. The stronger you think the line is, the hungrier the market becomes. Order blocks, magnets, not magic. Everyone loves calling out order blocks. But here's the truth, they're not footprints of whales you can copy. They're clusters of orders. That's all. Think of them as magnets. Price often returns to test them, sweeps through the extremes, then decides. 2 scenarios, rejection, sweep, reclaim, reversal. Acceptance, break, retest, continuation. Retail worships order blocks like sacred zones. But the market doesn't respect your drawing. It respects liquidity. Don't worship the box. Watch the reaction. The false breakout addiction. Breakouts. The sweet drug of retail traders. You see price pressing against resistance. Candle wicks touch it again and again. You start to believe, this time it's going to break. You load your longs. The breakout triggers. Green candle shoots up. Your dopamine spikes. Finally, profit. But then, in seconds, the candle reverses. Your stop loss? Gone. Your account? Bleeding. This is the false breakout trap. And it works because of psychology. Your brain loves confirmation. It sees the breakout candle and screams, "You're right. Get in." But the market knows this. That green candle is not confirmation, it's bait. The more obvious the breakout looks, the higher the chance it's engineered against you. The trap of revenge trading. Here's the darker side of liquidity. The market doesn't just take your money. It takes your mind. You lose on a false breakout. You're frustrated. Your brain craves revenge. It wants to get it back. So what do? You jump in again. No plan. Just emotion. And once again, the market hunts you. This is not coincidence. It's brain science. Your amygdala, the fear center, hijacks your logic. It forces you into impulsive trades. Institution doesn't need to trick you twice. Your psychology does it for them. Your biggest liquidity leak is not on the chart. It's in your mind. The liquidity pyramid. Think of liquidity like a pyramid. At the base, you have retail traders. Small accounts, predictable stops. Above them, swing traders with larger positions. Above them, institutions managing huge flows. Every layer feeds the one above. Retail feeds swing traders. Swing traders feed institutions. Institutions feed banks and market makers. It's a food chain. And if you don't know where you are in that chain, you're the prey. Liquidity always flows upward. The question is, are you feeding it, or are you feeding from it? How institutions thinks. Retail traders think in terms of lines. Support. Resistance. Trend lines. Institutions thinks in terms of pools. Where are the stops? Where is the resting liquidity? How can I push price to harvest it? Retail sees a breakout. Institution sees trapped traders. Retail sees a trend line break. Institution sees a stop raid. If your strategy is obvious, it's liquidity. If it's hidden, it's power. Liquidity and time. Timing is everything. Liquidity isn't just where. It's when. Notice how stop hunts often happen right before major sessions: London Open, New York Open, news events. Why? Because that's when liquidity spikes. That's when orders flood in. And that's the perfect time to hunt. You think volatility is opportunity. But often, volatility is a weapon, engineered to grab your stop before the real move begins. Liquidity doesn't just live on the chart. It lives in time. The midnight sweep. Have you noticed how price hunt stops when you least expect it? While you sleep. While you're away. While your guard is down. This is the midnight sweep. Asian session consolidations build pools of liquidity. Stops rest above equal highs, below equal lows. Then, London wakes up. And like a predator in the dark, the sweep begins. You think discipline means setting your trade and walking away. But discipline without awareness becomes bait. Your absence is their opportunity. The market doesn't rest when you do. Liquidity is unlimited. Emotional liquidity. Liquidity isn't just technical. It's emotional. Fear. Greed. FOMO. Revenge. Every time you break your plan, you add liquidity. Every emotional entry is a donation. Every over-leveraged trade is fuel for the hunt. The market doesn't just map price. It maps emotion. It knows when you panic. It knows when you chase. Your emotions write liquidity onto the chart before your stop ever does. The higher time frame trap. Retail loves lower time frames. 1 minute. 5 minute. Fast action. Quick dopamine. But liquidity is engineered on higher time frames. Daily equal highs. Weekly liquidity pools. Monthly supply and demand zones. The lower timeframe sweeps are just fragments of a bigger hunt. You think you're in control scalping noise. But you're playing chess blindfolded. The higher timeframes already scripted your loss. If you don't zoom out, you'll never see who's zooming in on you. The illusion of news. News drops. CPI. NFP. Interest rates. Markets explode. Retail screams, it's because of the news. But institutions knows, liquidity was waiting long before the headline. The spike is not caused by the news. The news is the excuse. The spike is fueled by stops. You think you trade fundamentals. But in reality, fundamentals trade you. The headline is not the reason. It's the weapon. Liquidity maps. If you want to stop being hunted, you must learn to map the hunt. Ask yourself, where are the equal highs? Where are the equal lows? Where is last day high or low? Where is last week high or low? Where is the order block? Where is the trend lines? Where is the support and resistance? Where are clustered stops? Where would I place my stop if I were retail? Then flip it. If retail stops are there, that's the magnet. The hardest part is letting go of your bias. You want to be right. But hunters don't want to be right. Hunters want to eat. Stop drawing charts for confirmation. Start drawing them for collection. The final words. Listen closely. Every loss you've taken. Every stop you've cursed. Every time you whispered, "Why always me?" It was liquidity. The market is not chaos. It's not random. It's a machine. A machine built to transfer money from the predictable to the prepared. And here's the haunting truth, you have a choice. Remain prey. Keep trusting trend lines, support, resistance, equal highs. Keep feeding the machine. Or shift. See the trap. Trade the trap. Flip from victim to predator. This isn't about being fearless. It's about being patient enough to wait for fear to do its job, for others. Liquidity doesn't vanish. It waits. The question is, are you waiting with it? Or being taken by it? The silent warning. Now you know how liquidity hides, how ranges trap, and how psychology fuels every false breakout. But here's the truth most traders never hear, this video is only scratching the surface. The market doesn't stop here, it has infinite traps, infinite hunts. And every trader who quits halfway becomes just another number in the pool. But you? You've come this far. You've seen how the game works behind the curtain. Now it's your move. Because the next time you look at a chart, you'll no longer see candles, you'll see intentions. You'll see manipulation. You'll see the invisible hands moving the market. And once you see it, you can't unsee it. So don't miss what's coming next. The deeper we go, the more the game reveals itself. Hit that subscribe. Stay with me. Because the next video might just save you from becoming liquidity.